Well, as we just mentioned, the U.S. Federal Reserve has delivered that widely expected 25 basis point rate increase, taking interest rates to their highest level in over 2 decades. Fed Chair Jerome Powell said that there's still a long way to go to reach their 2% inflation target, and that it would take time for the full effects of their rate hikes so far to take hold. So does he have another hike in the bag for this year, or what should the markets take from his comments today? For more, joining us is Thomas Hoenig, a former president of the Kansas City Federal Reserve and now a distinguished senior fellow at George Mason University's Mercatus Center. Thanks so much for joining us today.
Happy to join you. Thanks for having me.
So what jumped out to you about, the decision was widely expected, that 25 basis point hike, but anything from the comments in particular from Powell?
Yeah, I think, number one, he said nothing that was surprising at all. He's leaving all the options open and refusing to get into this, are they going to raise next meeting or not, or leaving hints there. So that's not a bit surprising. I think, though, the one thing that is not, and I'm surprised people aren't asking, I guess, is that as the Federal Reserve faces their next choice, one of the things going on is the United States is still experiencing a lot of stimulus from years of fiscal expansion, starting with the CARES Act, but also going through that to the CHIPS Act, to the Infrastructure Act, to the recent additions to spending, which actually put nearly $8 trillion of new money over that period into the economy. And that is an enormous boost to the economy. And that's why I think you've seen the modest growth continuing, even though on the other side of that, the Federal Reserve has raised interest rates by 525 basis points, which is a huge increase, slowing the economy, especially the interest-sensitive sectors. So it isn't just that the economy has been going along and the Fed raised rates, it's that the economy's had enormous stimulus, and against that, the Fed has raised rates. And that's why they're in this what I'll call a dilemma of what to do next. And they're going to wait and see, as Chairman Powell has indicated several times in his press conference. They have 2 more CPI numbers coming forward, 2 more employment reports, so they're going to weigh those very carefully before they make any decisions. And I think they're not talking about fiscal policy because they want to stay away from that, but that's a major factor as well.
So what do you think they should be saying about it then, in terms of maybe even just calculating the sort of timeline of when that stimulus would, sort of play its course through the economy?
Yeah, I think they should. The fact is that we have more uncertainty, really, regarding future spending plans. The Congress itself is in a debate on whether or not to stick with its debt ceiling limit and agreements around that. And yet some members of Congress are saying, no, we need to spend more money. Well, that will affect the economy going forward. And I think that's something the Fed has to take into account. And they ought to speak out on that because it's affecting their ability to conduct monetary policy. But Powell is very carefully staying away from fiscal policy because actually, he doesn't want them trying to interfere with monetary policy, so he's keeping that on the sidelines. But it's a major factor in policy deliberations going forward, I think.
When you're thinking about the strength of the economy in the U.S., this change in language from the growth being modest previously to now moderate, is that significant to you? I mean, it is a change, but is it a big change?
No, I don't think that's a big change. The economy would be a bigger change if they said the economy continues to grow modestly or moderately in the future, or right now, and would likely say so in the future. That might change things. But no, the minor change they made here, I don't think is going to affect the market's interpretations. Now, I could be wrong, but that's just my reaction to it.
And it sounded like, the Fed officials aren't expecting a recession anymore to be something that the U.S. has to deal with. Do you think that is going to play out that way?
Well, I think a recession is still a possibility very much because as you look at past cycles, if you will, where the Fed is, they're still early or at least no more than mid-cycle and compared to past ones. Let me give you an example. The Federal Reserve stopped raising rates in June of 2006. They really didn't have major problems or a recession like until the fall of 2007. And then Bear Stearns didn't have problems until the spring of 2008, and Lehman's didn't fail until the fall of 2008 as well. So that's 2 years after they stopped raising. So there's a long path ahead. And when they say monetary policy acts with long and variable lags, that's true. It's a fact. So there's still a risk of a recession as they tighten policy again today. And we don't know what they're going to do in September, but that'll be a factor as well. So yes, we still have a risk of recession.
Do you think that the Fed is doing a good job at balancing those, those future risks with the risk of inflation that's, right in front of their face right now?
I think they're doing as well as you could expect. They have inflation and they're facing it. They have an economy that still has a lot of stimulus in it, and they don't know how that's going to go. So they're trying to balance it. They're taking small steps, and I think that's what you would expect them to do. Their mistakes were made early in the process when they were too slow to raise rates when inflation broke out in 2021.
I'm curious, too, because you're not only a former regional Fed president, but you're also a former vice chair of the Federal Deposit Insurance Commission, the FDIC. And I'm curious what you make of the Federal Reserve's response to the uncertainty in the banking sector in the U.S. and how, it's sort of continued through with the, these rate increases during this time.
Sure.
But that uncertainty is still sort of lingering. And like you said, some of the worst situations didn't unfold until later in previous rate hiking cycles.
Right. Well, and they should be concerned because right now the U.S. banks have about $600 billion of unrealized losses in their bond portfolios. They're under pressure in their assets because interest rates have risen, so those asset values are under downward pressure, so they need to be alert to that. And in fact, I think the Federal Reserve tomorrow is going to release, they and the FDIC release a new capital proposal. People are already saying that raising the capital standard would raise rates on loans, and my response to that is the timing of the capital raise. They should have done that 2 years ago. But the fact of the matter is, if it raises rates, loan rates, it'll be a few basis points, and compare that to the 525 basis point increases they made over the last year and a half. So they need strong capital. They need to be aware that the industry is under pressure and be ready to deal with that as they continue to raise rates, at least through today. So there's more uncertainty on the horizon, and the Federal Reserve, has to be alert to that, and so does the other banking regulatory agencies in the United States, because their banks are under pressure.